This AI-generated podcast is for general information only and does not constitute financial or legal advice. Listeners should independently verify all information. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 29 May 2026.
Right, so let us dive straight into the material today.
Yes, let us get right to it.
So we're doing a deep dive into the regulatory mechanics of distributor controls. And if you are navigating compliance or product governance on a daily basis, you know this is a highly rigorous area of law. We are looking specifically at how financial products are mapped to clients, but we are doing it strictly through the lens of recent Luxembourg frameworks.
Exactly. And the foundational thesis we need to anchor immediately, and this is the absolute must-know key message for our entire discussion today, is this. Product governance is no longer a static, one-time point-of-sale check. It is a continuous, proactive legal duty. I'll say that again because it informs every single regulation we will discuss. It is a continuous, proactive legal duty. You are legally bound to actively monitor products throughout their entire life cycle.
That is a massive shift from just clearing a checklist at launch. And to understand how that continuous legal duty is enforced, we need to look at the actual regulatory texts. The master framework is Directive 2014-65 EU, universally known as MiFID II.
Correct. The 2014 MiFID II directive.
Right, but those overarching European rules need strict local application. And that brings us to our first core takeaway for today. The local enforcement in Luxembourg comes from the Commission de Surveillance du Secteur Financier Circular 23840, which applies as of 3 October 2023.
Right, and for the sake of clarity, we will refer to this as the 2023 CSSF Product Governance Circular going forward.
Perfect. So the 2023 CSSF Product Governance Circular outlines 3 mandatory distributor controls that practically define this continuous proactive legal duty. Oh. But before we get into those 3 controls, there's a very specific operational boundary regarding who this applies to.
Yes. The 2023 CSSF Product Governance Circular explicitly states these intense controls do not apply if the financial instruments are marketed exclusively to eligible counterparties.
Eligible counterparties. So we're talking about massive institutional entities.
Exactly. Major investment banks, sovereign wealth funds. The legal presumption here is that the information asymmetry, the knowledge gap between the manufacturer and the client, simply does not exist at that level. They have the internal risk models and quantitative analysts to understand complex derivatives.
I see. So applying retail-level frictions to those wholesale institutional markets would just stall the system without adding real protection.
Precisely. But the moment a product moves beyond eligible counterparties, when it hits professional clients or everyday retail investors, that is when the 3 distributor controls of the 2023 CSSF Product Governance Circular become absolute legal requirements.
Okay, let us break down those 3 controls. Control number 1 is identifying the target market. And this requires empirical mapping of the product to client needs and objectives.
Yes, and crucially, it requires identifying the negative target market.
Right, the negative target market. That is such a vital concept.
It is. You must explicitly document who must absolutely not be sold this product. If you have a highly volatile derivative, your negative target market might legally exclude anyone seeking capital preservation. And a newer layer here is the sustainability carve-out.
Ah, yes. I saw the ESG factors in the text.
Right. If a client has strict environmental or social governance preferences and the product does not meet those green criteria, they automatically fall into the negative target market for that asset.
Regardless of their wealth or risk appetite.
Exactly. Which brings us to the second distributor control, controlling the distribution strategy.
So aligning your sales channels with that target market reality.
Yes. The framework categorizes the service models into advice, discretionary portfolio management, and execution-only services.
And this leads directly to our second core takeaway. Because execution-only environments, like purely digital brokerage platforms, are designed for absolute speed and autonomy, right?
They are.
But under the 2023 CSSF Product Governance Circular, an execution-only channel does not exempt a distributor from intervention. You cannot just say, well, the client clicked the buy button themselves.
That is exactly our second takeaway. Client autonomy does not override your continuous proactive legal duty. If you make a highly complex instrument with a strict negative target market easily available on an execution-only platform with zero friction, your distribution strategy is legally flawed.
So how does a firm practically execute that intervention? Let us say I am on an execution-only app, and I try to buy a structured deposit that is clearly in my negative target market.
The intervention must manifest as coded operational friction. At a minimum, the platform's architecture must trigger a hard warning or an appropriateness test. But if the mismatch is severe, if you are clearly in that negative target market, the firm's compliance engine must physically block the transaction.
They just stop the trade entirely.
They have to. The distributor control supersedes immediate client autonomy to prevent catastrophic risk exposure.
Wow. Okay, so that is target market and distribution strategy. The third control under the 2023 CSSF Product Governance Circular is reviewing the product. And this circles perfectly back to our main thesis, right?
Absolutely. The continuous proactive legal duty. The initial target market assessment is just the baseline. You have to reassess when market conditions or client profiles change.
Which is a massive data challenge.
Yeah.
So how does Luxembourg actually force firms to build this continuous review machinery on the ground? That brings us to our third core takeaway today.
Yes. To understand the enforcement, we have to examine the Grand Ducal Regulation of 30 May 2018.
Okay, the 2018 MiFID II Grand Ducal Regulation.
Correct. And specifically, we need to focus on Article 9 of the 2018 MiFID II Grand Ducal Regulation. Article 9 is the engine that transforms the theory of distributor controls into an auditable, rigid reality.
Right, because Article 9 mandates the creation of the approval file.
The approval file. It is a mandatory continuous dossier required for every single product, and it is structured around 6 core areas.
Let us unpack those 6 areas because this is where the rubber meets the road for compliance teams. Area 1 is manufacturer details.
Yes, you cannot just file a marketing brochure. Under Article 9 of the 2018 MiFID II Grand Ducal Regulation, your risk teams must interrogate the manufacturer's stress tests and cost structures. You independently verify the risks.
Okay, Area 2 is the target market, which we discussed, defining the positive and the strict negative parameter.
Exactly, which directly feeds Areas 3 and 4, authorized channels and the service model.
Right, so if you determine in Area 2 that a product is highly volatile, Area 3 forces you to restrict the channel. You might say, this cannot be sold on the execution-only app?
Precisely. The approval file forces that structural boundary. You might dictate that the authorized channel is strictly the private banking arm, and the service model Area 4 requires an advisor to personally explain the risks.
I mean, that explains why certain complex structured deposits just disappear from retail platforms. The approval file physically restricted the channel.
Yes, and Area 5 is the compliance review. This is your internal audit log. It proves to the CSSF that your internal risk officers are actually enforcing these boundaries.
But Area 6 is what really highlights that primary thesis of a continuous proactive legal duty. Area 6 is the review trigger.
The review trigger is arguably the most operationally intense requirement of Article 9 of the 2018 MiFID II Grand Ducal Regulation. You must establish clear, event-driven parameters for reassessment.
Event-driven parameters. We're not talking about like an annual calendar review here.
No, not at all. You have to build quantitative thresholds into your digital risk management systems. For instance, if underlying asset volatility spikes beyond a specific percentage within a single trading session, that is a trigger.
So if the market crashes on a Tuesday, the system hits that threshold, what happens under Article 9?
The approval file effectively raises a red flag. It mandates immediate reassessment.
Yeah.
You have to ask, does this product still belong in the portfolios of the clients who hold it?
Right.
Do we need to temporarily halt new sales until the risk models are recalibrated? You are operating a real-time risk surveillance network.
It is just a staggering amount of legal and operational synthesis. So to summarize the architecture we have covered today.
Let us recap the 3 takeaways.
Right. Takeaway 1. The 2023 CSSF Product Governance Circular mandates strict distributor controls, target market, distribution strategy, and continuous review for anyone outside of eligible counterparties.
Takeaway 2. Execution-only platforms are not exempt. Coded friction must override client autonomy to prevent negative target market sales.
And takeaway 3. Article 9 of the 2018 MiFID II Grand Ducal Regulation enforces this through the 6-part approval file, turning firms into real-time risk surveillance networks.
And all of that serves our primary thesis. Product governance is a continuous, proactive legal duty. It never stops at the point of sale.
It really acts as an invisible regulatory shield. Every time a new portfolio management service is recommended, there is this massive, meticulously maintained approval file actively checking the match.
Then unless you are an eligible counterparty, there is no bypassing it.
Exactly. Which leaves us with a final, somewhat provocative thought for you to ponder. Given the rigid requirements of the 2018 MiFID II Grand Ducal regulation, monitoring these review triggers in real time and enforcing negative target markets, the data processing load is immense.
It is astronomical.
Right. So as artificial intelligence becomes deeply integrated into compliance infrastructure, how soon will the maintenance of the Article 9 approval file become fully automated?
That is a very real question.
I mean, if a machine can flawlessly monitor event-driven parameters, could a sophisticated algorithm eventually understand a client's shifting risk tolerances better than a human advisor? And if so, how will regulators adapt when the entity executing this continuous proactive legal duty is entirely synthetic?
It is the next major frontier for product governance law.
It really is. Thank you for taking this deep dive with us today.